This is the third worst October since 1987. How can we prepare? Joining me now, Frank Curzio, editor of the Curzio Research Advisory. Frank, welcome back. It's been too long.
Thank you so much for having me.
Do you come bearing better news than what we're seeing in the markets right now?
I think so. I think this pullback's a buying opportunity. I think a lot of the downturn is due to mostly technicals, right? You have a lot of algorithms in the markets now, and they're getting triggered at a 50-day, 100-day. It's automatic selling. But when you see this kind of selling, you always want to relate back to the fundamentals. And right now we're trading at one of the cheapest levels in the last 5 years on stocks. I mean, I've run screens where you have a great opportunity. More than 20% of S&P 500 is trading below 12 times earnings and growing those earnings by more than 20%, which I haven't seen in at least 3-4 years.
So it's not going to be a repeat of what we saw in 2008?
Not at all. I mean, if you're looking at something as the end of Western civilization, I can honestly tell you that there's less than a 1% chance that that would happen in our lifetimes. I'm not saying the market can't come down. We could, just like we're seeing now. These are normal conditions. You have, sometimes you go through recessions, sometimes you have pullbacks or 10% pullbacks, but it's different when you look at the banking system today.
So when you see the Dow dropping 1,000 points, you want people to know or remember perhaps the time when the Dow was even below 1,000.
Well, that's what people remember, because the last big crash was a credit crisis. So that's what we're going to relate to, but we have to realize that that hasn't happened ever, really. All right, so if you're looking at the banks, and I don't like the banks. I'm an independent person. I don't get paid by companies or anything. I just look at the data. The banks are more stronger today than they've ever been. They could withstand a 60% market collapse, minus 5% on GDP, a 35% housing crisis, home prices coming down, and they still have enough capital on their balance sheets that the Fed won't allow them to lend out.
Midterms are coming up, Frank. We're obviously going to be paying close attention to this. How could this change course for anything?
It could. It's just, that's one of the biggest threats right now, because our foundation was built on negotiating, arguing, fine, but after you're done and you get your points, usually solve your issues and you'll have a beer and hang out. There's like actual hate right now. There's nothing. Like, if you look, even Kavanaugh, whether you believe it or not, the fact that every single Democrat voted against and every Republican voted for, it just tells you that there's no independence, that these parties are so stubborn and really fighting right now. And that's a big threat to us, because they both ran on an infrastructure plan of $1 trillion. Both of them, both parties, Hillary Clinton, Donald Trump. And we still don't have that, because the parties can't, they both agree that we need, and this is something that's for the safety of our people, right? Building bridges, roads. And yet they won't agree on it just because they don't like each other.
Let's talk gold now, Frank. How does the metal fit into the investment cycle?
I'd buy gold right now. I mean, you're looking at it, and I know you hear that every single day for the last 5 years. But for me, right now, it's different, because the fundamentals make sense. So there is demand in the marketplace, not enough supply, not enough discoveries. But I think when we see higher interest rates, which goes against everything, right? Because you say, well, higher interest rates, you want to offer more alternatives, right, for interest. So you're going to take it out of gold. But what it's doing to the U.S. market is it's taking leverage out, because now you can't borrow as much. And with hedge funds and the amount of money in the market, they have to put it someplace, because they're just rotating it. And now they're rotating it into something that provides value. And if you're looking at the majors, they deleverage themselves significantly. And they're in very good shape to purchase some of these juniors. It's a much different market. And I think even if gold prices stay the same, you're going to see a lot of these gold stocks go higher. That got crushed, even though gold prices really stayed the same.
But do you think it's going to be a challenge getting investors back into the space when you're seeing the majors just getting plummeted here?
Well, not all the majors. I mean, Goldcorp really reported a bad quarter. Newmont Mining has significantly lowered their leverage.
Yes. I mean, it's across the board. It's not just Goldcorp.
Yes, but when you look at Newmont and look at 2013 compared to today, I mean, our leverage was 4 times EV to EBITDA, right? Not to get complicated, but now it's less than 1%. They're paying a dividend. They have plenty of cash on the balance sheet, waiting to purchase projects, and all these guys produce for under $1,000 an ounce, which means even if we see a 10% correction, they're still going to make money, and they're trading at dirt cheap valuations. They're heavily shorted right now. You're going to see that change once the fundamentals come back into the market, but it's going to offer a great opportunity for value.
All right, Frank Curzio, thank you so much for your thoughts.
Thank you.
Thank you for watching. We'll have much more for you on Kitco.com.